What's up, everybody? This is episode 4 of the Smart Real Estate Investment Podcast. My name is Brian Graham. Today's episode is called Determining Your Real Estate Investment Goals and Criteria. So in this podcast episode, what we're going to be talking about is exactly that: how to determine your investment goals and your real estate investment criteria. Meaning, what are you trying to achieve with real estate investing? And as always, before we get started, I've got to read the disclaimer. So again, I am not a financial advisor. The information provided during these podcast episodes is not intended as financial, legal, or professional advice. It is your responsibility to conduct thorough due diligence, seek the advice of qualified professionals, and make informed decisions based on your individual financial situation and goals. So, determining your real estate investment goals and criteria. Where do we begin? We begin with the question, what is your ultimate goal? What are you trying to achieve the absolute most long term? That is what your first question should be when we begin investing. No one just throws money at something, hope it sticks, and I just start making money. That's not how anything works. We've got to figure out, what is our investment goal? What are we trying to achieve? So that could be different things. Are we trying to create long-term wealth? Are we trying to create passive income? Is it a mixture of both? So what that means is we need to set clear and well-defined goals. So are you someone that has a 9-to-5 job that may or may not enjoy it? For those that don't enjoy it, from what I've heard, usually the reason is they don't have enough time in the day to reinvest in themselves. They don't have enough time in the day to reinvest in their families, or they just don't have enough time to do what they want. There's so much time involved in their 9-to-5 job, and now it almost seems like it's an 8-to-7 job in many different careers. But so much is involved in that job, you don't really have much time to invest into yourself, into your family. So is it a goal of yours to get that time back? To exit the rat race of that 9-to-5 job? Is your goal for real estate investing just to have a side gig or a hobby? Just to have some fun, do some work with your hands? Do you want to supply housing to people in need and to make some money on the side? So those are some different reasons why people would invest. So me, for example, my objective is I want to create steady monthly cash flow. I want to replace my work job, which I'm a strength conditioning coach. I want to replace that job's income with real estate cash flow income. So that way, when my wife and I decide we want to take a week or 2 off in our job, because since we work for ourselves, we don't get paid time off. So if I make $2,000 in 1 week and I take off and I spend $2,000 on a vacation, that's a $4,000 swing. It costs me $4,000 now to go out of town for 1 week. But so my objective is to replace that 9-to-5 job, replace that strength and conditioning income that I work for with real estate income. Now what I can do is I can take off knowing that every month I'm going to be getting cash flow from real estate. And that makes me go to sleep at night knowing I have a steady income, that I don't have to be sweating or be hesitant to take off work just to go out of town and have a vacation with my family. So ask yourself that question. Look in the mirror and say, you and your spouse, or just you, if it's just you, it's totally fine. But look in the mirror and say, what do I want? What is my goal? Determining what your ultimate goal is can help you determine your criteria, because that will dictate how risky you want to be, how high your return of investment is, and what type of strategy you use. A different podcast, we're going to be talking about different real estate strategies. But So determining what your goals are can help you determine your criteria. So with that, you want to determine what you want your return of investment, your ROI. You want to determine what you want your return of investment to be. So I refer to this as your cash on cash return. That means I'm going to put down, let's say, $10,000, and every year that's going to return me $1,000. That is a 10% cash on cash return. So if you sell that property later and you make 20 grand, you've taken that 10, you've turned it into 20, you have doubled your money. That is a 100% return overall. But your cash on cash return is what we refer to as the monthly cash flow return, on a per year basis, because you may not get a double or triple your money until 2 or 3 years later. You could be in 1 year, but usually it's not. So I highly recommend you determine what do you want your return on investment to be. And most people, myself included, when I'm determining a return of investment, that return of investment is working with market conditions. I'm willing to take a lower return of investment the worse market conditions are, and I'm looking for a more aggressive, higher return of investment the better market conditions are. So for example, when COVID-19 happens and the housing market, the prices and appreciation skyrocket, the interest rates are very low, my cash on cash return was very good. I'm looking at somewhere between 20 to 35% return of investment on my money in cash flowing properties. So that would be I invest $10,000 and I'm getting $2,000 to $3,500 per year. It was very good. Now market conditions are harder. And if I want that same kind of return, I have to be a lot more patient and I have to be a lot more strict and diligent into each property I'm doing due diligence on. And it takes a lot more. I probably look at 100 to 200 properties per week and just analyzing them through the listing. Just easy, just one after the other. It's probably more than that. That's probably a low number. But looking at one property to the next, and just by looking at the cash flow it produces or knowing what it can rent for, looking at the cost, immediately you can figure out, is that going to be a decent return? But when you determine your return on investment or your cash on cash return, I highly recommend you look at what is that return compared to other investments. So you can put your money in a stock, you can put your money in index funds, you can put it in ETFs, CDs, you can do high interest, high yield savings accounts, you name it. Just know that you're most likely always going to make less money if you give your money to someone else rather than doing it yourself. So if I invest my money into real estate myself and I do the work myself, I can make upwards of between 20 and 35%. If I give my money to a stockbroker and he invests it, either aggressively, medium, or lightly, he can make me anywhere between 6 to 20%, maybe. But he's going to take a percentage based on the trades that he does. So I'm going to make less money. When you're determining that return on investment, also take into consideration, especially for real estate investing, there are many different ways to make money long-term with real estate investing. And this is long-term real estate investing. There are 4 main ways. You have cash flow, you have appreciation, you have tax benefits, and you have the equity paydown. So with cash flow, you're looking at monthly positive cash flow. After all expenses are paid, what are the profits of that? That is your monthly cash flow. This is long-term properties. I'm talking about something that's held for 1 year plus. The appreciation of that property. So if you buy it for $100,000, it appreciates to $120,000. You make the difference. You made $20,000 on that property. That is appreciation. That is an extremely strong benefit because you're using the bank's money for that growth. The tax benefits. So there's and we will get into tax benefits in a different podcast, but the main benefit to tax benefits of real estate investing is a phantom benefit called depreciation. It is a tax deduction that you do not pay for. So in order to deduct something, you have to buy it, so you're out of pocket that money, but then it goes against the earned income of that property. But depreciation, you do not have to come out of pocket any money. So if you invest properly, usually that cash flowing property will be tax free if you can do it properly. And then the fourth way is equity pay down. So every month you have to pay down the mortgage. And if you have monthly cash flow on top of that, the mortgage counts as an expense. You pay down that mortgage, and part of that goes, towards your equity of the property. And those are the four main ways to make money in long-term real estate investing. All of those included, if you calculate that into your return of investment, that will by far exceed any ETF finding the correct property. There's no question. Now, you can make a lot of money day trading. You can make a lot of money in the right stock. I had, $2,000 in Tesla 5 years ago. And had I kept that, it could be worth, I don't know, $600,000 now or something ridiculous. I can't remember exactly. But there are many more ups and downs with a single stock. In the meantime, that 2,000 at one point would have been worth 1,000. I would have lost 50% of my investment at the time. And it's so liquid, you have to have the emotional stability to have that stock. But with real estate, it's not liquid. It's not as liquid, meaning if an opportunity came up and I had a property, I needed to sell it overnight, I can't. It takes time for that to happen, at least a week. If someone comes in and offers me a property cash, they're probably going to want an inspection. They're going to want we got to go under contract. They're going to want to tour the property. It's going to take at least 7 days, and that's with a cash deal. So real estate investing is not as liquid, and therefore, depending on how you look at it, could be a better investment because real estate is not as liquid. In my opinion, I think the less liquid, the stronger emotional stability that comes with it. So if, nowadays in stocks, you have everything at the push of a button in your hands on your phone. You invest in Robinhood. All of us have Robinhood. You invest in Tesla, Amazon, Google, whatever. The stock loses plus minus 5 to 10%. If we're playing with 20 to 30 plus $1,000, we could lose, $2,000-$3,000 a day. It can be so emotional for the average retail Joe Schmo looking at that stock where they just go, oh man, I'm going to sell it. And then it bounces back the next day and they lost out on that regrowth. But in real estate, there's so much fluctuation every day with the rates, with the appreciation value, with this and that. And it's not as liquid, so you're forced to leave it there. If you make or lose $10,000, you're still getting monthly cash flow from your tenant. You still receive the tax benefits. They're still paying down your equity. So it's less liquid and therefore less of an emotional roller coaster and much more beneficial, in my opinion, than a typical stock market investment. So that helps with into our next topic is your risk tolerance. So determining what your risk tolerance is can help you determine your goals and criteria. So can you go to sleep at night knowing that you might lose your investment? That's an extremely important question to ask yourself when determining what your goals and criteria are. So everything I just talked about was talking about long-term real estate investing. There's short-term real estate investing. There's Airbnbs. There's flipping homes. There's wholesale investing, which are much more quote-unquote job-like, where it takes more time out of your day to manage those things. But if I'm doing flipping or I'm doing wholesaling, I could make a serious amount of money in a short period of time. I could double my money. I'm making 10 to 15% every month rather than 20 to 30% over a year's time with cash flowing properties. However, the risk is higher. So let's say I buy a property for $100,000. I'm going to put 50 grand into it. I'm going to sell it for 300. All of that sounds good. In some markets, that opportunity may exist. You can make you can double your money, make 150 grand, which sounds amazing. Well, who wouldn't do that? But let's say it happens over the course of an election year. Let's say COVID-19 happens in the middle of that, and everything tanks. Nobody wants to move. So now you've got what could be 3, 4, 5 months of holding costs, and now you can't get out. What are you going to do? You wanted to flip that property, and now you have to change your strategy. So that brings us into our next topic, which is staying up to date on the current market conditions of real estate investing can help you determine what your goal is at any given time. So if your initial goal was, I'm going to flip this property, you've got to be very, very aware that at any time market conditions can change, and you have to change your goal along with that. You have to be able to adjust. So I'll give you an example. During COVID-19, I bought this property. It was a single family home. I had great cash flow because I got an investment property interest rate at 3.6%. That's unheard of. Usually only primary residents can get an investment mortgage of 3.6%. And the cash flow was excellent. But now that property appreciated about $40,000 to $50,000, which is again fantastic. And if I were to buy that property now, I'd be looking at a 6.5% to 7.5% interest rate at the current rent. That property cannot cash flow. It can't. It will break even. If somebody put down 20%, it will break even at its current price. But when I bought it back then, I was making $500 a month. So in that moment, that long-term goal of appreciation, cash flow benefit, all of those great benefits, that goal was achieved. But because the market conditions changed, I cannot buy that same home with the same goal. So it's got to be a different goal, or I have to buy it a different way. I could still make great money if I buy it cash, looking at a lower return of 10 to 12, 15%. But I'm looking for 20 to 30% return. So I cannot buy that single family home in this market with the same goal. So that's why you have to adjust. So what do? I have to figure out what market can I get into that where I can find those same cash flow goals with these current market interest rates. So I have to what I've been successful doing is finding 2 duplexes, 2-unit buildings, triplexes, which are 3-unit buildings, and quadplexes, which are 4-unit buildings. Finding those properties where the rates, even at 6.5 to 7.5%, still cash flow to give me a return of anywhere between 20 to 35%. It's difficult. They're in some rural areas. Some of them are Section 8 tenants, which we'll have another podcast about. Some of them are low-income housing, but because there's so many units, they are able to provide me that monthly cash flow, even though the rates are high. So what am I going to do when the rates drop? Well, that's a good question. So it depends. Once the rates drop, I'll have a conversation with my realtor. If she tells me that the prices have appreciated in such a way that it makes more sense to sell those properties, I'll sell them. If not, I'll most likely just keep them and refinance them to a lower interest rate. That way they cash flow even higher. So if I refinance them from roughly a 7% interest rate, I can refinance them hopefully down to a 5 or 5.5% interest rate, and they'll cash flow anywhere between $50 to $75 per month more, and which is a much higher return. We're looking at $600 to $900 per year, which is much more attractive, because which could result in anywhere between 10 to 12% more of my return on investment, because we're talking about $100 to $150,000 properties. The next topic would be, what is your exit strategy? So you have your goals, you've got some investment criteria. What is your return on investment? 10, 20%. What are you looking for? But when you buy these homes or buy these properties, you have to determine what is your exit strategy before you buy it. Now, let me repeat that. You have to determine your exit strategy, or a couple different exit strategies, before you buy the home. You buy a home for $100,000, you put down 20 grand, market conditions change. How do you get your money back? How do you sell it? There's different ways you can exit. You can just sell. You can do owner financing. You can do a lease option agreement, which we can talk about at a different podcast. But the market conditions will change, and the rates may change, and that may change whether or not you decide to sell. So you could do a 1031 exchange, you could just sell it, you could hold it, you could refinance it. But determining how you're going to exit the property or what you're going to do if market conditions change is very, very important. Very rarely, I'm not going to say very, very, very rarely does sitting on your hands and doing nothing really benefit you. It's always important to stay up to date on market conditions. There are some investors out there, I've heard this, that I've never sold a single thing that I've owned. They pay down their debt and they just keep the property cash flow. But what I've been able to do is from the very first property that I bought and I held for 2 years, and I sold that single family home, single unit, into 5 units. And I sold both of those and I multiplied that into 14 units and so on. And it's continued to multiply. And that's what you're able to do by not sitting on your hands. So yes, they would still be cash flowing properties. I would still be making money if I held them, but I would be losing out on all that equity that is in those properties because they've appreciated so much. It made a lot more sense to sell that and then snowball that into more. So I very much recommend always keeping up on market conditions because that may determine what your goals are at that time. You have to adapt. You have to adapt to the market conditions. You should always be willing to change your investment strategy or change your criteria based on those market conditions. So we usually save the end of our podcasts for questions from social media and live viewers at the time. And something that people have always asked are, how do I get started? I've seen a lot over the last week of looking at social media, viewers and people commenting on my videos. And 2 questions. One, the first one is, how do I get started? And I covered that in a previous podcast, but I think you have to start by looking in the mirror and saying, what do I want to achieve? That is the first question you need to ask. What do I want to achieve? And then figure out how you save up that money or who you're going to get that money from in order to invest and what kind of property that's going to be. The second question is, or rather it's a comment, and in one of my videos I talked about how to save money, and I talked about different bank accounts. So I talked about a personal bank account for the husband, a personal bank account for the wife, and 2 joint accounts. That first joint account is going to pay for joint expenses, rent or a mortgage, car payments, groceries, electricity, gas, TV, your Netflix, all of that. And then the second joint account is going to be your investment account. And most people were saying, in that video you said 80% was going to go towards our investments. What if 80% goes towards only our payments? We don't have anything left over. That is true in many parts of the world, in many parts of the country. I totally get that. The numbers I'm throwing out were based on where I currently live, which is in Maryland, which is a very high cost of living. I believe we actually have one of the top 5 highest cost of living in the country, behind certain parts of California, New York City, and maybe even New Jersey. So yes, that may be true. Maybe you don't have 80% to be able to put towards some investment once expenses are paid. I totally understand. But I challenge you to think about how you're going to make more money. I challenge you to think about, if you're unhappy with how much money you're currently making in your job, I challenge you to think and question, how can you get more money? Do you possess a skill that somebody else needs, whether it's in your circle of friends, your family, your friend group, your community, your kid's school? Are you a volunteer coach? You name it. Is there a skill that you can provide? Maybe you're a coach that you can provide lessons on the side. Maybe you're a teacher that you can provide tutoring sessions. Maybe you're an expert welder. Maybe you're good with your hands. You can become a licensed contractor. Maybe you know how to fix cars. Some type of skill that you are willing to offer somebody. And people are looking for, believe me, people are looking for, if they know that you can paint, they know that you can help them do daily chores. Maybe you can start a lawn mowing business. You can do power washing. I mean, there are many different ideas. And all it takes is just starting with a friend group and saying, hey, I have a power washer. I'll do your driveway for $40. And someone says, yeah, sure, I've always wanted to do that, but I don't have one. I don't want to rent one. They'll just pay you whatever you charge them, within reason. If you can't get them for 50, maybe you can get it for 30. Maybe you can get them for 25. Whatever it is, you have to start somewhere. And then once you build that business, you start to make more money.